Hey everyone, in today's video, we're going to be talking about what I think is one of the most important things for retirees to understand and avoid in retirement. And we're talking about Social Security's hidden tax trap, something called the Social Security Tax Torpedo. And again, I think this is one of the most important things for retirees to be aware of, be able to identify in retirement, and also be able to avoid because it applies so broadly to so many different retirees. Basically, if you have a Social Security benefit, this Social Security Tax Torpedo is something that you might potentially be subject to and very likely to be subject to as well. So throughout this video, we're going to walk through how the Social Security Tax Torpedo is created, what it means for your retirement, why you want to avoid it, and how you can avoid it as well. But before getting into the meat and potatoes of this content, if you've been watching our Safeguard Wealth Management YouTube channel and you've been liking our videos, you may or may not know this, but 70% of the people that watch our videos are not subscribed. Okay, so basically what that means is they are being suggested our content by YouTube. And the problem with this is we release videos weekly. Okay, and if you're not subscribed to our channel, you're not seeing the latest videos that we're releasing. You're just depending on YouTube to suggest that content to you. Okay, and YouTube's algorithm's changing all the time. So you want to make sure that if you like our content, if you're wanting to learn more about how you can make your retirement better, use the money that you have to propel your retirement forward, make sure you hit the subscribe button, hit the notification bell, so you'll be notified of all future videos that we release. Okay, so let's talk about evading the Social Security Tax Torpedo in retirement. So something that I want to discuss off the front end is the workers' tax system. Okay, and I've called this the workers' tax system for a while. On the screen right now, I have the 2021 single filers, married filing jointly, and head of households brackets, tax brackets. Okay, many people are familiar with these tax brackets. Now, while you're working, while you're saving for retirement, things are pretty simple in the tax system. Okay, you're earning money from your job, and in various times throughout your life, there are various deductions that you're able to take in order to lower your taxable income. But for the most part, the income that you're earning basically plugs into the system, and the tax system is fairly simple. There's not a whole lot that you can do. Okay, so I call this the workers' tax system because, again, it's something that many people are familiar with, especially as you've been working for the last 30 and 40 years. But once you enter retirement, this tax system completely changes. Now, how does it change though? It changes because of how Social Security is taxed. Now, if you're not very familiar with how Social Security is taxed, last week's video, last Friday, we released a video talking through a bunch of different examples, laying out exactly how Social Security is taxed. Okay, it's all based off this provisional income formula, and then it plugs into this table. If you're not very familiar with how Social Security is taxed, I highly recommend pausing this video and going back and watching that video that we released last week. I'll link to it in the right-hand corner of this video. I'll also include the link to that video within the description as well. That's going to be very important as we talk to the Social Security Tax Torpedo and understanding how exactly this tax torpedo is created. It's created because of how Social Security is taxed. And basically what happens, okay, as you're taking income from taxable income sources, it's raising your provisional income. Well, as your provisional income rises higher, okay, you're being taxed on, let's say you take $1 from your traditional IRAs. Okay, so you're being taxed on that dollar, but that dollar also raises your provisional income. Well, raising your provisional income causes Social Security dollars to also now become taxable. Well, so those Social Security dollars that now become taxable, you now owe taxes on. So essentially $1 pulled from your retirement assets is not only taxed on that dollar, but also taxed on that Social Security benefit, the amount that it moves into Social Security's taxability. And so essentially it creates a double taxation zone. That's what this Social Security Tax Torpedo, this hidden tax trap is all about. It's about double taxation from pulling money from your assets, causing your Social Security benefit to become taxable as well, causing that double taxation. Okay, so let's go through an example. Let's go through a graph. And we're going to go through an example of a single filer's tax torpedo first, and then we're going to step through and go through an example of a married filing jointly tax torpedo as well. So this person, this individual, is taking $34,000 from Social Security. Okay, that's their Social Security income. Okay, on the right side of the screen here, I have their Social Security tax torpedo graph. And essentially how you read this graph. Okay, in the background of this graph, we have their $34,000 from Social Security already in the background. Okay, then what you want to do is you want to look at the x-axis down here, income from taxable sources. Basically how you read this graph, as you take more income from taxable sources, you'll see your marginal bracket rise. Okay, this red on the screen right here is what most people intuitively think their marginal tax bracket would look like at these given ranges. The blue line here is the Social Security Tax Torpedo. Okay, so what you're going to notice, the first money that this person pulls from their taxable income sources is going to be underneath the standard deduction. Okay, so that money, again, is going to raise their provisional income. It's going to cause some of their Social Security benefit to become taxable. But again, even that Social Security benefit becoming taxable and the income that they're pulling from those taxable income sources is underneath the single filer's standard deduction. But as we can see, as they take more and more income from their taxable sources, we start to see the Social Security Tax Torpedo breakout, basically. And what you'll see is the marginal brackets rise 50 to 85%. And why 50 to 85%? Again, the reason being is because they're hitting zones where they're seeing their Social Security benefit become 50% taxable within these zones, and then become 85% taxable, again, within those provisional income zones. So you're going to see this marginal bracket rise 50 to 85%. So what's interesting, most people think the next step then, as they're pulling income from their taxable sources, is they're going to be taxed at 10% here. And then they're eventually going to be taxed at 12% here. But what actually happens is they never actually see the 10 and 12% marginal bracket. The reason being is because, again, as they're pulling income from taxable sources, it's causing their Social Security benefit to be taxed as well. So they actually see the 15% marginal bracket. And then next they see the 22.2% marginal bracket. And again, this is a 50% step up here and an 85% step up from their intuitive rate here. And again, all of this is happening, again, because as they're pulling income from taxable sources, it's causing their Social Security benefit to be taxed. They're being double taxed. And so all of this zone from right here all the way over here is the Social Security Tax Torpedo. Now, the most volatile part of the Social Security Tax Torpedo we can see over here is this 40.7% zone. Okay, and basically, again, this is created because they're eventually enter what they would think would be the 22% bracket. But that 22% bracket, their marginal rate actually goes up 85% to 40.7%. Okay, let me show you exactly how this works out. But again, just to step back for a second, obviously this is something that every retiree wants to be aware of because, again, we have options in retirement to pull from various taxable sources. Okay, we can pull from traditional IRAs, that's fully taxed. Okay, we can pull from capital gains, long-term capital gains, that's going to be a slight tax preference, or we can pull from Roth IRAs. Okay, Roth IRAs basically exit this tax torpedo. Okay, if they pulled, let's say they needed a certain level of income and they pulled the first, let's say $10,000 from traditional IRAs, so they're underneath the standard deduction over here, and then they pulled the rest of the income they needed from Roth IRAs, they wouldn't see this Social Security Tax Torpedo at all. So again, this is extremely important to know about what your actual marginal rate is, and does it make sense to pull from a taxable income source and thus take that marginal rate that might be 50 to 85% higher, or does it make sense to pull from a different account? But let's explain essentially how that 40.7% zone is created. So again, remember that this person is taking $34,000 from Social Security. Let's say they're also taking $35,000 from their IRAs. Okay, so their provisional income is going to be $52,000. Okay, they're going to be in the 22% bracket, right on the edge. Okay, so they're in the 22% bracket, and let's say in the middle of winter, the dead of winter, their car breaks down, and so they need to take it in to get repaired. It's going to be a $1,000 repair. So they're going to need to pull an extra $1,000 from their IRAs. Now remember, they're in the 22% bracket. So intuitively, what most people would think would happen is they're taxed on that $1,000 withdrawal, they're taxed at 22%. And that is true, but it's not including the whole equation, okay? Because yes, they are taxed at 22% on that $1,000 withdrawal. So they do owe $222 in federal income taxes on that $1,000 withdrawal. But that $1,000 raises their provisional income as well. Well, raising their provisional income means that that $1,000 is going to move $850 from their Social Security benefit into now becoming taxable. That's also going to be taxed at 22%. So if we take $850 and we tax that at 22% as well, they're gonna have a additional tax liability of $187. Okay, add those two together and they get a tax liability of that $1,000 withdrawal of $407, otherwise known as 40.7% marginal tax rate on that $1,000 withdrawal. So again, this is why it's so extremely important to know. 40.7% is higher than the largest or the most extreme part of the workers' tax system right now. Okay, the last tax rate in the workers' tax system is 37%. And what you'll notice, much sooner within the retirees' tax system, they're being taxed at 40.7%. So again, this is why it's so important to know what your tax brackets look like in retirement, to know which accounts you should pull from at a given time in a given year. Okay, and also knowing what your tax brackets look like in the years to come as well. So if we look at a married filer's tax torpedo, let's say they're taking $65,000 from Social Security between the two spouses. Okay, what you'll notice with the married filer system is basically this tax torpedo elongates, if you will, meaning that they're able to take more income from taxable sources before hitting the tax torpedo. You'll also know, though, the higher their Social Security income is, the longer this tax torpedo is. Okay, so again, we see the first part here underneath the standard deduction. They're not going to owe any taxes, but as they start to pull from income from taxable sources, again, they'll see their marginal bracket jump. At this point, given their specific tax torpedo, they're not going to see a 50% jump at any time. They're only going to see an 85% jump. So again, they're never going to see this 10% bracket. They're never going to see this 12% bracket. It's actually going to rise to 18.5%. And then once again, 22.2%. So what's interesting here, most people think it takes quite a long time. They'll have to pull quite a lot of income in order to hit the 22% bracket. But as we see, based on these marginal brackets, because of the Social Security Tax Torpedo, the 22% bracket actually starts much sooner, much earlier in the income that they're pulling from those taxable sources. And then once again, we see the 40.7% zone here. And again, it's important to understand that this is going to look different for everybody based on how much they have coming from Social Security. It's going to look different for a single filer. It's going to look different for married filing jointly. Again, because of the tax brackets for each of those given tax statuses is different, but also based on how much Social Security income they have. Okay. One thing that's very important to understand, this tax torpedo, if you think it looks bad, these marginal brackets look bad now, just wait until 2026. For those that don't know, in 2026, the Tax Cuts and Jobs Act is set to expire. It's set to sunset. Okay, well, Tax Cuts and Jobs Act was put into law effective for 2018. Basically what it did is it lowered each bracket by anywhere from 2 to 4%. Okay, so basically what happened prior to the Tax Cuts and Jobs Act, we saw the 15% bracket. Okay, there was no 12% bracket, but after the Tax Cuts and Jobs Act, this 15% bracket turned into the 12% bracket. The 25 turned into the 22, 28 turned into the 24, and so on. Basically, the Tax Cuts and Jobs Act, it lowered each bracket by anywhere from, again, 2 to 4%, and it raised the standard deduction. So in layman's terms, what the Tax Cuts and Jobs Act did is less of your income was taxed, and it was taxed at lower rates. Okay, now these don't seem like big adjustments, a 2 to 3% adjustment in tax rates, but it will make the world of difference. Okay, and again, this is set to sunset in 2026. We know taxes are going up in 2026. Well, what does the tax torpedo look like then in 2026? Again, using the same Social Security income of $65,000, and what happens? The 10% bracket isn't changing. That didn't change because of the Tax Cuts and Jobs Act. So this first part is going to look exactly the same. What you'll notice, though, as well, the standard deduction, because the standard deduction is going back down, you'll notice that this tax bracket starts much sooner than before. If we looked at this before, again, it was almost until $20,000 of income pulling from taxable sources before we saw this Social Security Tax Torpedo. Well, now it happens much sooner. Okay, again, then we start the Social Security Tax Torpedo from this point all the way into this point. But look what happens to these marginal rates. Before, the marginal rate was 22.2% within this zone. Now we're going to see it at 27.75%. So again, if we just step back here, 27.75% as compared to the current tax rates puts you basically right in between here. Some pretty hefty marginal rates. Okay. Then the 40.7%, the most volatile part of the tax torpedo, goes from 40.7% all the way up to 46.25%. So again, it's so important to know not only what your tax graphs look like this year, but also going forward into the future. This tax torpedo looks much worse in 2026. So there are some important things to know about this tax trap. The first, this tax torpedo, as I mentioned before, will look different for everyone. Okay, everyone's tax torpedo graph will look different based on how much you have coming from Social Security. It's also important to note, I've seen this in some of our past videos, that people are saying, okay, this Social Security tax torpedo barely applies to anybody though, right? In fact, it applies to almost everyone that has a Social Security benefit that is taking any reasonable amount of income from taxable sources. You will see and be subject to the Social Security tax torpedo. Again, as you see here, this person has a base income of $65,000 coming from Social Security. And as they're pulling $20,000, $40,000, $60,000 from taxable sources, you'll see they're entering this tax torpedo at each of those points. So again, this is something that everyone, almost everyone, is going to face. As we're running plans throughout our practice, this is something that applies to, again, everyone that we plan for. And it's something that we want to identify and avoid for everyone that we plan for. Okay, and the other important thing to know, due to something called stealth taxes, you will naturally drift further into the tax torpedo. And what do I mean by that? Well, what do I mean by stealth taxes? Well, for those that don't know as much about the history of Social Security taxation, in 1983, Social Security started becoming taxable. Okay, and it started becoming taxable at various provisional income levels. The thresholds were $25,000 for an individual, $32,000 for a married couple. Well, guess what? It's still at today. Well, I don't have this. It's still at $25,000 for an individual and $32,000 for a married couple filing jointly. Social Security starts becoming taxable based on those provisional income levels. So this is something that isn't adjusted for inflation and hasn't been since 1983. There's no discussion of it being adjusted for inflation. So what does this mean? Okay, well, if we look at your provisional income through time, Social Security is an inflation-adjusted asset. So you're going to see your Social Security benefit rise through time. So your Social Security is going to go up through time. Okay. Also, because of inflation, you're going to have to pull more from your retirement assets through time as well. If you need $70,000 at the start of retirement for your income, by year 15 in retirement, you're going to need much more than $70,000 because of inflation. To have the same purchasing power, you're going to need income raises throughout retirement. So once again, if you're pulling from taxable income sources, you're going to see your gross income also rise. Well, if both of these things are rising, it means your provisional income is rising as well. So through time, basically what this means in layman's terms, as your provisional income rises, more of your Social Security benefit is going to be taxable. So what's going to happen? Basically, as we move through time, you're going to slowly drift further into the Social Security tax torpedo. Okay, if you start retirement and you're right here pulling this much from your taxable income sources, as we move through time, if you continue to adjust for inflation, your Social Security benefit continues to adjust for inflation, you're going to slowly keep stepping over this way and potentially even see yourself eventually step into this zone as well. Okay, so you will drift into the Social Security tax torpedo through time because of this stealth tax. Not a lot of people know about it. It's something, once again, that you want to plan for to avoid. Okay, so there's some different findings that we've had from analyzing this tax torpedo for so many different retirees, helping so many different retirees avoid this tax torpedo. The first one is that forced and guaranteed income is not ideal. Now, if you're someone who has a pension from the government and you don't have a lump sum option, take the pension, obviously, and you're just going to have to, play the cards as they fall. But a lot of advisors push income annuities for clients. And we're not big fans of income annuities. I think they don't apply to the vast majority of retirees. I don't think they make sense in the vast majority of retirees' situation. A big reason why is because of the Social Security tax torpedo. Okay, it's the same reason that if you have a lump sum option or a monthly pension option, you should very much consider lump summing your pension. Okay, because think about it. Okay, if you're forced to take guaranteed income from a taxable income source, okay, and let's say you have, however much coming in from Social Security, okay, and you also have guaranteed income from a pension or from annuities, and let's say you have $50,000 coming from that pension or that annuity, okay, no matter what, without even thinking about any other income that you might have from taxable accounts, from long-term capital gains, from any other income sources, each and every year you will basically be guaranteed to be right at this point. Okay, and why is that? Because it's forced taxable income. So this is something where this isn't ideal because of tax planning. It's why again, if you have that option with a pension to lump sum, it's something you should consider. Now, taxes alone aren't the sole reason you should lump sum a pension. There are obviously a lot of different other variables. Make sure that you're analyzing that situation completely. But nonetheless, forced and guaranteed income should make you pause because of the Social Security Tax Torpedo. It's also important to know RMDs need to be minimized to avoid this tax torpedo. Let's say early in retirement, when you're on Social Security, you fall right here on the Social Security Tax Torpedo. And then once you turn 72, because you have large tax deferred balances, okay, you're forced to take RMDs. RMDs are required minimum distributions. The government is going to force you to take money from your traditional tax deferred sources. Well, all of that is taxable. And so let's say you're right here starting out in retirement, but once RMDs start, those RMDs push you over into this zone over here, fully subject at this 27.75% marginal rate, and also fully subject at this 46.25% rate as well. That RMD is all of a sudden very expensive to your retirement. So this is something earlier in retirement, you want to know that that is going to be a risk and avoid that risk. Perform things like Roth conversions to avoid those RMDs to keep yourself in a less volatile part of the Social Security Tax Torpedo. And then finally, withdrawal order is paramount. Most retirees have 3 different buckets they can pull from at any one time. They can pull from tax deferred sources, taxable sources, which is typically long-term capital gains, or Roth IRAs. Okay, each of those carry a different tax consequence. Each of those will translate to a different tax liability within this tax torpedo. And so your withdrawal order in a given year and throughout your retirement is paramount in order to save on taxes. Okay, making sure that you have the optimal withdrawal order. And unfortunately, this is something that's not discussed enough. It's something we're going to be recording a lot more videos on. So if that's something you're interested in, again, make sure you're subscribed to our YouTube channel so you're notified when we release those videos on withdrawal order. But it's something that is extremely important to avoid this Social Security Tax Torpedo. Okay, so hopefully this was informative, kind of explain the tax torpedo and showed different ways that you can avoid the tax torpedo, showed why it's important to your situation, showed basically the tax liability it creates, and again, why it's important to plan around the Social Security Tax Torpedo. Let me know if you have any questions in the comments below. I'd be happy to answer those questions. Always remember, you don't need more money. You need a better plan. Don't forget to hit the subscribe button so you're notified of all future videos that we release. Thanks for watching.